March 9th, 2024, we got a spike on the opening range and a measured move down of it. It wasn't the low of the day, but it was essentially where the bottom of this leg stopped. And that's pretty much always going to be a support point. Whenever you get a spike on the opening range, you're usually going to get a measured move in one direction or the other. Um, had this pulled up, but just a couple examples: spike, measured move, down, measured move, down, measured move, and spike up. So just a couple different examples there. And a lot of times you end up getting the measured move in the other direction. So when the market fails to break out to the upside here, like it did, and then you start to get big bear bars closing near the lows, 19 and 20, you might be getting the measured move in the other direction. Bar one, a bull bar closing near its high. One more thing actually I wanted to go over was really cool was we ended up having basically a fight over the open of the week. And the open of the week was right here on this. So 51.35.75. And if you look at 51.35.75, it's really interesting when this happens. So that's that price right there, right? And you can see at the end of the day, we were basically just bouncing up and down around that price. And the reason being the weekly chart. When you look at the weekly chart, the bears really wanted to get a bear close because we've had so many, bull closes in the past couple of days. And so, or a couple of weeks. And so bears really wanted to end up getting a bear close here. And we were oscillating essentially right around the open of the week. And we had this big bear trend day leading all the way down. And then bulls spotted up through the open of the week. And then you can see we just ended up basically oscillating around it, fighting until the last second. And bears ended up winning and getting it closed just below the open of the week by like a point or two. So it's always interesting when that happens. So that's why the open of the weeks are usually important on Fridays if it's a close magnet, because the trade, it usually ends up oscillating around that price. Bar one, a bull bar closing near its high, but really not all that great. I'd rather wait. It's breaking out above the prior day's high, so you'd like to see more follow through. And you get bad follow through on bar two, so not really all that great. It is still technically follow through because it wasn't a bear bar, so it is technically still follow through for the bulls on bar two, but it's really not as good as it could be. Additionally, one more fact about today: today was an outside day. You can see it went above the prior day's high and then below the prior day's low, so it was an outside day. And 70% of the time, if you get an outside down day, the market is going to close within the lower third of the outside down day, which you can see it did here. And same thing with an outside up day, 70% chance it will close in the upper third. So, outside days aren't all that common. When you get them, 70% chance you're going to close in that lower third. Follow through for the bulls on bar three, but a tail on the top. It's always in long probably at this point, but it's not all that great. It looks like we're going to end up getting more of a trading range open than a trend from the open. Big bull bar on bar four. It's a surprise, so it's by the close, reasonable to be long, okay to be buying the market, but you are getting relatively high here. You should note, though, we do have an open gap with the two high and the four low, meaning the traders who sold above the two high and scaled in are currently trapped. They'll probably stay trapped throughout the spike phase, but the question becomes, are we going to get a deep pullback and let those traders out and form some sort of trading range, or are we going to get a weak pullback and then some sort of attempt at a trend up? Follow through for the bulls on six. So it's a clear spike on the open. It's a surprise potential bull trend from the open, possibly going to get a bull trend day today, but we need to continue to get follow through. 7, tail on the top. 8, tail on the top. So this is starting to get weaker. You can see the momentum is waning. Really after 4, you started to see the bars started to get smaller. But you do have another open gap with the 3 high and the 5 low. So a couple areas here where traders sold above and ended up getting trapped. So we have trapped traders here and trapped traders here. Bar 9, buyers below 8. Why are there buyers below 8? Well, we haven't traded below a bar yet all day, and we haven't had a bear close yet today. So bulls are pretty willing to buy below 8, betting that the first reversal down is going to fail, and they're going to be able to at least make a scalp. And you can see that's pretty much exactly what happened is, this is the close, right? So bulls bought here, took maybe a 2-point scalp back up to the close of this bar, and then they sold, and that's what's causing 10. Any bulls who were buying up here were disappointed that 9 was a bear close and it traded below 8, so they ended up exiting and causing 10. You sell below 10? I don't think so. I think it's a low probability high of the day. After this much bullishness, I'd rather wait for a pullback and then look to buy because we're probably still always in long, but always in long bulls are going to exit below 11, below 10, but they might look to get back in relatively soon. Doji bar on 11, we're probably going to get 2 legs sideways to down. Two legs, 10 bars, something like that, sideways to down. So I'd expect at least an hour of sideways trading. But, at this point in the day, it's probably not a bear trend day. It did end up being one, but the odds at this point in the day were low that something like this was going to happen, which is why this is such a surprise. 13, Bad follow through for, or sorry, 12. So, any bear who sold 10, hoping for the prize, doesn't get it on 11. They buy back their shorts, causing a bounce on 12, but not really many buyers up here, probably sellers above 11. It's a high one and three straight bear closes. 13, a second leg down for the bears from here, and they get follow through on 14. 13 is a double top, or you could argue that 12 was the double top with maybe 9 on neckline 11, and we broke below it. Maybe we got some sort of measured move down a bit. I don't know. I used to, back like a couple years ago, I used to try to, this is going to be a bad example. Well, first off, don't do what I'm about to say, but I used to look for like tight trading ranges, like something like this maybe, and I'd look for the measured move of the tight trading range. Yeah, this is a good example. I'd look for the measured move of the tight trading range. So I'd see this tight trading range and we'd start to break up below it. And I'd look for the measured move and I'd set a limit order to buy right here. And I'd buy and try to make a scalp basically. And it worked a good amount of the time. But the problem is when it didn't work, I would end up just losing buckets of money. So it's not a good strategy. It was just one of those things that I did. And it helped me learn a lot about tight trading ranges and measured moves, etc. But anyways, back to this. So follow through for the Bears on 14, but not very good. An outside up bar on 15, but no one really wants to buy this high in the tight trading range at bar 15, big bar, big risk. Probably better to buy below 15, which is exactly what the Bulls did. So whenever you get like a buy signal bar like 15 high in the trading range, and you think, well, the bar is pretty big, Bulls probably aren't going to want to buy above that bar because the bar is too big. But the context isn't awful for the market to continue up. You should be thinking that Bulls are probably going to try and buy below the bar instead of above it. And usually, if you're at the bottom of a trading range and you start to get a context that's a good setup, but the bar ends up getting too big, traders often look to buy a 50% pullback of that bar. Buyers below 15 during 16, 17, a bull bar, but 4-bar tight trading range, 14, 15, 16, 17. I think if you're buying above 17, you have to have a wide stop and be willing to scale in. And the traders who do have a wide stop and are willing to scale in, they see 18. They're not really, I don't think 18 is super deterring if you're long. It could be essentially it's 3 pushes down and the Bears are going to try and get a breakout below the wedge and a measure move down, but it's not all that likely that this is going to go super far. So if you're a bear, you can see this is another example. We had this measured move. So this wedge basically, right? 1, 2, 3. So we essentially had a wedge here and then we got a breakout below the wedge on 19 and we went for a measured move and that's where 21 hit. And that's why we got profit taking right here because the traders who sold for any reason in here or here, a lot of them took profits here. That's why we got that bounce on 21. But it was just bears taking profits more so than bulls buying. But 19, anyways, if you bought here, I think it's probably okay to stay long from 18 because you're expecting the market to go more sideways. It's a tight trading range. But if you're buying up here, you're expecting to be able to scale in and make money. And then you see 19. And if you see 19, you probably just take your loss. 19 is a way bigger bar than bulls wanted. They thought if we went down here, we'd probably find buyers and get some sort of bar with a lot of buying pressure again. And instead, we get a big bear bar closing near its low and huge follow through for the bears on 20. So if you're long and you see this, thinking, okay, maybe we trade a little bit further somewhere down here, but we're probably going to find buyers. You have these open gaps, so you're hoping there are going to be bulls buying here, bulls buying here. And then you see that, and that's a huge bear surprise. And we're probably going to get at least a second leg down. And then it gets follow through. So now at this point, when you get a surprise like this, at least I'd say 60% chance that we're going to get down here before we get up here. Maybe even, more like 65. And you can see that's why we ended up finding profit taking here was because of this measured move. 21. So 1920, big surprises. 21, some profit taking towards the bottom of the trading range and at that measured move. And you can see the bears who were short 19 and 20, they were hoping to get big follow through on 21 again, but they don't get it. And 21 closed stronger than bears wanted it to. So bears would exit above 21. And instead of exiting above 21, what did they do? They sold the market and they drove the market down, causing 22 basically. So they never let the market trigger. There were a bunch of bears ready to get out above 21 if it triggered, and institutions know that. And they sell the close of 21, trying not to let it trigger, risking, 2-3 ticks, 3 ticks to a point, trying to make, 9, 10, 20, however many points. So it's a low probability trade, but it works enough at the time that it's profitable. Follow through for the bears on 23. So you have another pair of consecutive bear bars. We're probably going for the measured move. And additionally, 90% chance we're going to get a breakout of the 18 bar range. And you can see that after 2020 or 1920, 90%, very likely we're getting down here. Follow through 24, disappointment 25, because, a couple legs down and probably just profit taker since we're so low here. We're also around yesterday's close, which is always going to be a magnet. Bounce on 26, but this isn't all that good. If you're out above, you definitely don't have to get out above 25 if you're an always in bear. It's okay to stay short. And 26, it's follow through, but the reality is you're probably not going to get much more follow through. Bears might look to exit above 26, and you can see that's why 27, again, bears sold the close, didn't let it trigger. And then another leg down 28, and something important happened here. It's really subtle, but if you bought below one, or you bought the one low essentially, right? You scaled in lower, and you're looking to get out of your first entry with a profit, and your second entry, your first entry around break even, your second entry with a profit, it would have touched your limit order here on 26 and 27, but it usually has to go one tick past your limit order in order for it to get filled. So it probably had to go one tick above this for those bulls to get filled, and it did not. So they did not get filled. So what this means is it's slightly more bearish than it appears to be right now. What's happening through here? Well, I'll explain in a second. But 28, a bull bar, but small bull body, probably buyers below, probably sellers above. It's a low one short for the bears. We are in a bear trend, but you don't want to sell a bull bar. 30 follow through for the bears, but it could be 3 pushes down, 1 pull back, 2 pull back, 3, maybe pull back 4. So we're probably going to start to go sideways here. Outside up 31, really not all that great, just really sideways behavior. I think we're probably going to try to do one of two things. We're either going to try to form some sort of midday reversal. This looks like, it's a little stronger than I'd like it to be for a midday reversal, but it's possible that we try to form some sort of midday reversal, or we're going to get some sort of failed breakup to the upside and then a second leg down, which is what ended up happening. Second leg from this move, leg 2. 32 outside bar, so it's an 00, 31, 32, and buyers below on 33. Generally with an 00, you're probably going to get some sort of measured move down, or some sort of measured move based on the height of the 00. I don't want to sell below 32. I think you're selling so low in a tight trading range, and we're a little oversold. We probably need to bounce. So failed breakout 33, but doesn't close on its high, so traders aren't buying. 34, it's probably another low one short, essentially. Breakout pullback from this, but it's a tight trading range, and I'd rather be flat. Bad follow through on 35, big tail on the top. And you can see if anyone sold below 34, 35 is a bad follow through. You do not want to see 35. What you want to see is a bar like 41. If you're selling this and you want to see a breakout far below the tight trading range and you don't get it, so traders buy back their shorts, cuts in 36. Do not buy above 36. It's the top of the tight trading range, 29 through 36. If you are buying above 36, you're hoping that we're going to get a big move up, a big surprise up. And if we are going to get that surprise, it's better to just wait for the surprise to start. So 36, not a very good buy, tight trading range, and your signal bar was 35. Bad follow through 37. Traders who do buy above 36 see 37, and they just flatten at the market, causing 38. Probably sellers above 38, you can see during 39. So it's another reason, right? Bears, bulls who bought, let's say they bought above 36, they scale in a couple points lower, and then 39 gets back to their initial entry price. And this is not what you want to see if you buy above 36. No one wants to see this as follow through. You want to see big follow through. And you're not getting it. So those traders, they scale in and they make money on their second entry and get out around break even on their first entry. And they know selling above 38 is reasonable because it's a bad high one at the top of the tight trading range at the moving average. 40, good bear bar closing near its low. It's always in short. I think if you're a bear and you were always in short, you probably had to exit above 36, but good to put the short back on below 40. Like I said, open gap. So maybe we get, some more follow through, maybe some sort of measuring gap, right? So just in general, 18, but you could argue 18 bar range breakout and maybe a measure move the 18 bar range. A lot of ways to look at it instead of the opening spike. Big follow through for the bears on 41, closing near its low. A lot of bears selling below 40, looking to get short again, afraid they got trapped out above 36. Follow through 42. 41 is really climactic, so you might see some profit taking soon. And follow through 43. And then we end up getting profit taking. Bears able to make about 15 points selling below here. And they were only able to make, or not quite 15, but they were able to make at least over 10 points selling below here and 10 points selling below here. So you can see the legs are getting smaller, momentum obviously starting to wane down here anyways. But 42, 43 follow through for the bears. And then you get 44. I think it's hard to be short through 44 because you're pretty oversold at this point, and it makes sense to take profits with somewhere down here with like 15 points if you're short for anything. We do end up getting an open gap with the 33 low and the 44 high, but we're probably going to close it at some point today. It's really unlikely that this channel is going to remain like this the remainder of the day. We're probably going to start to go sideways relatively soon. We've had a couple of climaxes down, 1, 2, and then maybe 3. but we're probably going to start to go sideways relatively soon. And additionally, so look at 43, right? Should you ever buy above 43? Does that look like a profitable thing to do? No. Yet, if you did buy above 43, you were able to make exactly a 5-point scalp. So the bulls who bought above 43 made 5 points, and bears are going to be getting out 1, 2, 3 points above here. So it's notable that a stop order bull could have made money buying above 43. That means the pullbacks are deeper than you want them to be on 44. So when traders are able to make scalps in the other direction, your trend is probably not as strong as it should be. Bear bar closing near its low 45, always in bears can sell again. Doji follow through on 46, and then a bear bar closing near its low 47. You say this is the low one short, bad follow through, but a good bear bar, so traders keep selling. And then you get climactic follow through 49, 50, bull doji bar 51, consecutive sell climaxes. I would get out, maybe not above 51, but a couple points above 51, definitely above 53. 52 is a bad low one short, and it's just a pair of doji bars, so I don't really want to sell 52. Probably bears are getting out above 53 or 54, and that's what causes 55. When you get these big bounces to the moving average, this is bears exiting shorts. But we're at the moving average, and it's the first time in a while. So, even if we break above it, we're probably going to start to go sideways. Additionally, we're right around the open of the week, right, that I mentioned, and that's a really important target. So you have to keep in mind that, it's 35.75. So I'll just leave a little. So additionally, we are around the open of the week, basically exactly at the open of the week, one tick above on this bar. So we're probably going to start to oscillate around it. Bad follow through 56, since it's right on the moving average. Bad follow through 57, and then a bull bar 58. Do you buy above 58? I would probably wait for better. You probably could have bought 55, but I just think it's, if you're buying above this at this point and you sat out of all of this, you're probably missing the point of the day. This is much easier to make money. What I mean by missing the point of the day is, trade management wise, it's much easier to manage these types of trades where, you sell 40, you just get out above a bull bar or a couple points above any bear bar. You sell 45, you just get out above a bull bar or a couple points above any bear bar. If you're buying in here, it's kind of tough because that this is good enough for a second leg, but we could find sellers at the moving average and maybe get to a new low. So you might have to scale in. So, when I say the point of the day, I mean the easiest way to make money during the day, trade management wise, because, you can theoretically enter on any bar if you can manage the trade correctly. But the easiest trades to manage today were, in here, not up here. 59, reasonable buy, but, probably a bit climactic, but it is a tight channel. We might get to the top of here since this could be where the trading range started, which is actually ended up roughly where we got to. Doji bar 60, not great. Follow through for the bulls 61, closing your tie, an okay swing buy. Bad follow through 62, bull bar closing your tie 63. One of the reasons bulls bought the close at 62 was because they knew bulls were going to exit pretty soon here, a couple points below 62 probably, since this is a dangerous area to be long because of how tight this was. So that was one of the reasons why they bought the close, trying not to let it trigger below. But this could be a spike and then some sort of parabolic wedge channel. 1, pullback, 2, pullback, 3. So the pullbacks are 60 and 62. And it could be a parabolic wedge on a smaller time frame with a signal bar 64. So potentially, I guess, a sell 64 since it's a parabolic wedge. 65, you can see the traders who bought above 63, scaled in 64, disappointed. So they're getting out here during 65. Disappointing follow through 66. This probably needs a second leg. We get a second leg up 67, and then a big bear bar closing near its low 68. Surprise, always in short, okay swing sell. And we got 2 legs down and then oscillated around the open of the week. But another reason probably okay to sell 67, close below the moving average. And this was essentially a whole big gap bar. So you're going for a new low and moving average gap bar. And, the open of the week's a big magnet. So we're very likely going to get to the open of the week. And if you make it to the open of the week, I guess that's 8 points. But you see bull scalp with bear scalp with around 5 points on below 68. For stop entries today, probably 5, 6 is okay. 19 and 20 are good. For stop, I thought 17, with the open gaps, if you're taking it for a swing and you're willing to scale in, it's probably fine. I don't think this happens all that often. I suppose with the context on the daily chart, with us being as overbought as we were, it made that a less reasonable trade. But definitely 19, definitely 20. Probably sell the close all these bars. I would not buy anything. Sell 40, 41, 45, 47, 49, 50. But really getting far away from the moving average here. Same thing here. You're getting really far away from the moving average, so hard to sell. here, getting really far away from the moving average, 50 or 49.50 to want to sell. Could probably buy 55, but hard to want to do first touch of the moving average when they've been selling the moving average all day. But big bull surprise, good enough for a second leg. Probably can buy somewhere up in here. You can probably sell this on the weekly chart. Well, I'll start with the daily chart. Yeah. So tight bull channel, but bear bar closing near its low. It's an outside down bar. Theoretically, probably a credible sell, betting on a failed breakout above the channel, essentially. But reality is it's a minor reversal. We're probably getting back to the moving average, but not too much further. But I'd pay a lot of attention if we find sellers below this low next week. So Monday's an important day. On the weekly chart, the doji bar, we're pretty high up, so we could see something similar like we saw this last week, where bulls, or like we saw on the 5-minute chart all the time, bulls who bought above this high, they wanted good follow through, and they instead got disappointing follow through in this bar. So I'll be interested to see if the bulls who bought above here are disappointed enough in this to exit when we get back to this high. So I'd pay a lot of attention to the high of this week as well, or the 226 week, so that if we get back there and start to find sellers, that's a resistance area. Anyways, yeah,